Good afternoon, everyone. Those who've just joined us, today is our investment tax relief webinar with Colin Downing. Colin, if you're ready, I think we should start.
Okay.
Thank you.
I will share my screen.
Thanks, Colin.
Hopefully that will come up in a second. Not that one. That's that one there. Okay. Can you see my slideshow, or is it just Susie's?
No, that's all good.
That's there. Okay. Because it's not coming up on mine. Okay. Right. So this afternoon, I'm going to talk about mainly enterprise investment scheme tax reliefs and also the younger sibling of that, the seed enterprise investment scheme. I will touch on venture capital trusts, but mainly I will be talking about SEIS and EIS. So the enterprise investment scheme has been around for a good number of years now. It started virtually 29 years ago and has been £18 billion worth of investment that's been achieved by that scheme alone. 28,000 companies, more than that, have now had an EIS scheme. The younger sibling, SEIS, came in 2012. That's for startup companies, so very young companies that are just starting out. EIS is generally where you'll progress after you've had an SEIS scheme, or indeed you can jump straight to EIS if you're not a startup. VCTs, venture capital trusts, also cover startup companies all the way up to AIM listing, and we will touch on that a little bit later on, but mainly I should be talking about EIS and SEIS. So let's have a look at the background to the EIS scheme. So it's intended to encourage UK investors to invest in equity in unquoted trading companies. There are various tax benefits for that because the government are trying to encourage you to do that. There's some upside benefits to it, so tax reliefs, etc., and some downside reliefs should things not go according to plan. And it also helps unquoted companies to raise the finance which they've viewed as a funding gap historically. So that's why it was put there in the first place. So here I've got a table of the main reliefs. You'll see a star next to the SEIS column there with 200,000 next to it. That's because in his latest budget, the Chancellor increased the relief there. Now, originally it was 100,000. It's now gone up to 200,000 per annum for an SEIS investment. Now, whilst he mentioned it in the budget, it's not law yet. So until the Finance Bill becomes a Finance Act, it could change. It's unlikely, but it's possible. Or they could change the rules relating to it. So if you are looking at making an investment of that sort of size, or getting someone to invest that sort of amount, at the moment, if that's likely to happen before, on or around when the Finance Bill becomes Finance Act, which is generally June, July time, then we're suggesting that you do the investment in two tranches. Do your first 100,000 and a second one of whatever the balance might be up to the second 100,000. That way, if they do change the rules or suddenly reverse it back to the 100,000, at least you would get the 100,000. If you just did one lump of 200,000, then you could lose the lot. So all the tax reliefs, etc. on it. So that's one suggestion there that I'm going to cover today. The table's quite useful here, so you might want to keep hold of this. to refer back to later on. So EIS, Enterprise Investment Scheme, you can invest £1 million or up to 2 million for what we call KICs, which is a knowledge intensive company. VCTs up to 200,000. The tax relief, income tax relief that you get there is along the top, which is 50% for SEIS. So regardless of what tax rate you're paying, you will get 50% tax relief for the investment you make in SEIS, providing you have sufficient tax paid to give your investment that level of tax relief. So if you invested £100,000, you get 50,000 back. But if you haven't paid 50,000 in tax, then you won't get that full amount back. So you need to think about how much is going to be invested before jumping in with both feet. Tax-free exit. So providing you meet certain conditions, when you sell your shares, if you sell them for 50,000, 100,000, 100 million, then it could be tax-free. That applies for all of them, whether it's SEIS, EIS, or VCT. For VCTs, you get tax-free dividends received, but the other two, unfortunately, you will have to pay tax on any dividends that you do receive. Capital gains exemption. So when you invest your £100,000, if you put that into an SEIS scheme, then you can have, if you've got another gain, you sold something to make that investment, or indeed just sold something and made a capital gain, then you can have 50% tax relief or exemption effectively on that gain in relation to the level of investment that you've made. With EIS, you can only defer the gain until a later date. So if you defer the gain, what happens is the gain comes back into charge when you actually sell the EIS shares later on. And I'll have a bit more on that in a minute. For VCTs, unfortunately, no capital gains exemption there. There's a qualifying period there. Again, I shall come more into this a bit later on. 3 years for EIS and SEIS and 5 years for VCTs. Inheritance tax exemption. It's not directly related to SEIS and EIS shares, but it's the way you have to qualify for those release means that you will inevitably get inheritance tax relief, providing certain other conditions are met, but VCTs don't have IHT exemption. So the investor tax reliefs for SEIS and EIS. There are various requirements that you as an individual have to meet before you can get the tax reliefs that are on offer. First of all, you must not be connected to the company that you're investing in. So you must not be an employee. You can be a director, but there's certain rules relating to that, which I'll come on to in a minute. And you must not have a substantial interest in the shares of the company. So in this case, it's more than 30%. And again, there are some more rules on that, which I'll come on to in a minute. No related investment arrangements. Again, I should talk about that in a minute. No linked loans, no tax avoidance motive. So it's a bit tricky here because they're giving away some tax relief, but effectively what they're saying is that you can't invest in these shares just to get the tax relief that you want to get. If it will be difficult for the revenue to be able to say, yes, you were doing it just for the tax release. But if there were some way of doing that, then potentially they could refuse it. You mustn't receive value from the company, and an EIS investor mustn't hold any other shares other than the EIS, SEIS, or VCT, etc. Again, I'll come on to these in more detail in a minute. One thing that is extremely important is if you're going to look to get the exemption on the eventual sale of your shares, these SEIS or EIS shares, etc., then you must have claimed at least £1 of income tax relief in order to get hold of the capital gains exemption at the end of the day. So that is extremely important. If you don't do that, then the revenue will refuse the exemption at the end of the day. So EIS release, income tax relief, is generally up to 30% on the £1 million invested, which is good news. So providing you've paid enough tax, then you can get your 30%. It's straight 30% regardless of whether you're paying tax at 20%, 45%, or anything in between. Knowledge intensive companies, you can pay in up to £2 million investment in that. And I'll come on to what a knowledge intensive company is a bit later on. You can carry the relief back to the previous tax year if that works better for you. So if you suddenly find that you've invested at the beginning of the tax year £1 million and then something happens, you don't have the income you expected, then you can carry that relief back to the previous year. So that's one possibility if you have an issue during the tax year after you've made the investment, for example. Tax relief is limited to the tax liability for the year. So if you haven't paid enough tax, then that will restrict the amount of tax relief and therefore tax repayment that you can get. The CGT exemption and income tax relief. So gains on disposal of EIS shares, qualifying EIS shares, are exempt from capital gains tax, provided, as I mentioned just now, that you claimed at least £1 of income tax relief. And that means if you have to disclaim any of your personal allowances or other things there, then you need to make sure that you have claimed at least £1 of your EIS relief. Shares have to have been held until the termination date. So if this applies generally where a company maybe goes into liquidation, etc., you can't just sell your shares before that. If the company's going into liquidation, you're going to make losses, then you need to hold them till that termination date. And I think I've covered everything on there. So capital gains tax deferral relief. Here you can have a gain, not just necessarily in the year that you're making the investment. You can have a gain from 1 year before to 3 years after you've made the investment. And where that happens, you can say, okay, I want my gain on that you're trying to tax me, I want that deferred into my EIS investment that I've made. And that can defer tax on anything up to 28% if it's on dwellings, or 20%, or indeed perhaps 10% if you're getting entrepreneurs relief. The usual 30% of shares can apply, but generally if the 30% restriction, which is there for income tax relief, doesn't generally apply if you're just deferring your capital gain into an EIS investment. So if you're purely doing an EIS investment to defer your gain to a later date and you don't need any income tax reliefs, then you can ignore the 30% shareholding limit, but that means you will not get the income tax release. The other thing to bear in mind is the gains that you're deferring into EIS will come back into charge at a later date when you dispose of those EIS shares. The other thing that's important is if you've got entrepreneurs relief, so that you would be paying 10% at the moment, when that gain comes back into charge in 5-10 years time, whatever, then it will still have that 10% tax rate applied to it. It won't go to the full tax rate at that time, but do watch out because tax rates might change between now and a few years time when you dispose of the shares. That typically could happen, for example, if there's a change of government, they might increase the capital gains tax rates beyond where they are today. So what happens if things don't go according to plan and the company that you invest in ends up going into liquidation or just collapses and the shares become totally worthless? Well, there's some relief for the losses here. You will have invested some money at the beginning. You got some income tax relief, but then you get nothing back or very little back, and you will have made a loss. You can then claim that loss either against other capital gains or claim it against your income. Generally, it's better to claim it against your income because the tax rates there can be somewhat higher. So the example I've given here on this slide is an individual who makes £100,000 initial investment into EIS. They've got their 30% tax relief, £30,000, and then they've lost the rest. So they've lost their remaining 70,000 that they haven't had any relief on. And the government will give you, at the moment, up to 45% tax relief if you're a 45% taxpayer. That gives them another 31,500. So your actual net loss for your £100,000 investment is only £38,500. So not as bad as if you just invested 100,000 into a company, got no tax relief whatsoever, and then lost the lot. The inheritance tax business property relief effectively exempts the shares from inheritance tax, whatever the value that they might be. As I said earlier, it's not specifically an EIS relief, but in this case, any company who qualifies for giving EIS relief will meet the conditions for business property relief. So 100% business property relief, you do need to hold the shares for 2 years. And then after that period, it will get the 100% relief should you pass away unexpectedly. So the tax liability on the value of those shares in your estate will be nil. Okay, so I was going to pose a question here, which if I can find my notes. The question is your company less than 2 years old? Now, if it is, all the bits that I've just spoken about on EIS could apply if it was a very rapid and significant value in that company in that short period of time. But most companies start from very low beginnings. And this is where the seed enterprise investment scheme started back in 2012. And they're specifically targeting those startup companies, those who are generally less than 2 years old. Although in the budget recently, he's extended that to make it less than 3 years old. So caution retail at the moment, if it's less than 2 years, that should be fine. But if it's less than more than 2, but less than 3, then you might want to wait for the finance bill to become law before proceeding. So for the seed enterprise investment scheme, the tax relief, as I said before, the income tax relief is at 50%. It's available for the tax year that the shares are issued to you. But again, you can carry this back 12 months to the previous tax year. The maximum investment is up to 200,000 once the finance bill becomes law. And that investment can be carried back, as I say, to the previous year. It's targeted at smaller companies, which is what they would be at startup time. Again, capital gains tax exemption on sale of the shares, should they make a gain. And if you have other gains that you're effectively reinvesting or investing into your SEIS shares, then it will be 50% of that gain will be exempt, the rest will be chargeable. That's exempt, not deferral, so it is properly exempt, disappears, that's it, end of. Okay, business angels and EIS, again, SEIS as well, potentially. Company directors do not qualify generally for EIS relief unless they are referred to as business angels. And here there are two options where you can qualify as a business angel. First of all, you can be unpaid or not entitled to any remuneration. Or secondly, you were not a director before you made your EIS investment, and also you need to meet, in this case, certain other conditions. So for unpaid directors qualifying for EIS, you mustn't be remunerated or entitled to remuneration. But that doesn't mean you can't get certain payments. There are certain permitted payments that you're allowed to get. Necessary expenses, for example, if you were providing property to the company or similar things, then you can have commercial interest, commercial rent, dividends, of course, and payment for certain goods that you may supply to that company in the course of your business elsewhere. Reasonable remuneration for services is allowed, but here there's some rather complex wording which I could read out to you, but in essence, you cannot be in the same business as the business that the company, the EIS or SEIS company, is actually doing. So by way of an example, actually no, I'll come back to that in a minute. By way of an example, if you are a plumbing merchant elsewhere in your business and the EIS company was also into plumbing, then you wouldn't be able to supply that company with goods, etc. But if you're a plumber and this company happens to do making widgets, but then something goes wrong, they need some plumbing sorted out, new boiler, etc., then you could do that in the normal course of your business and be paid the normal rate for providing that. Payments to connected persons is a very important clause and can catch a lot of people out. I'll come on to it with an example later. But these will, where they are to a connected person, will be treated as payments to you and will then negate all the income tax relief that you've had. So it's very important not to get caught out by payments that are made to someone else, which you thought totally innocent, but can actually mess up your income tax relief. So paid directors qualifying for EIS, they mustn't be entitled to remuneration or actually remunerated before their EIS investment. But once they have become paid or entitled to remuneration, further EIS investments can be made, but only for a limited period of time. So if you make your investment, for example, on 1st of April 22, and then you're appointed a salaried director on the 1st of May that same year, you will have up to the 31st of March 25 to make any further EIS investments into that company, after which they will not qualify for EIS. And there's another bear trap there to watch out for, which I'll come on to in a minute. So no non-qualifying shareholding requirement. So here, in order to claim your EIS relief as an investor, you mustn't hold any shares, any other shares in that company, which are not EIS or SEIS qualifying shares. So if you hold ordinary shares and then try and make an EIS investment, they won't qualify. Equally, as I have seen, if you've got EIS shares and there's maybe another investor has invested in the company at the same time as you may know them quite well, made EIS shares investment, and then they get further down the road and go, okay, I don't want these shares anymore. Do you want to buy them from me? And you go, yeah, it's okay. It's a good price. I'll pick them up cheap. You won't acquire them with the EIS benefits attached to them. It will be exactly the same as if you bought them from anybody else. And then you have non-qualifying EIS shares, which will then negate the tax relief and all the tax benefits that you have on your other EIS holding of shares. So do not buy any other shares whilst you have EIS shares in that same company, because it will mess up your tax release. And you won't be happy when the revenue come along and say they want their money back. To get EIS shares, it must be a subscription for brand new shares, fully paid for in cash. EIS is not available if you buy, as I said, from another investor. I mentioned earlier about associates or connected people. Individuals here will be disqualified if they or an associate, which can be a business partner or a family member, if they're an employee or director of the company. So, for example, if a shareholder invested £100,000 in company A, his grandson, for example, needed some work experience a couple of years down the road, he has a word with the CEO, says, do you mind if he comes and does a bit of a summer work? Could be paid a very small amount, but that's enough. You're treated as connected to that individual, and all your tax release on those EIS shares will go. And if you've made a big investment for the sake of a few £100, that is not a path you want to go down. Okay, so some of the other pitfalls for investor tax release of SEIS and EIS. There are a lot of very detailed rules here, some of which I have already touched on, certainly the ones that tend to catch most people out where that applies. Investors and their associates, so obvious ones will be wives, children, etc., together must not hold more than 30% of the share capital. You need to keep an eye on that as well, particularly if the company buys back subsequently any shares from other individuals. So you might have started out at, say, 28%, and then there's a buyback and all of a sudden you creep above the 30% after that. So you need to watch out for that. The responsibility for dealing and making sure that you meet all the rules doesn't end once you get the investment. You need to continuously meet the various conditions, that's you, the investor, and the company, for at least 3 years and keep it under review. For EIS in particular, there are some requirements on the use of the funds that it has received from the shareholders investing in EIS shares. It has to use them in the business that it's initially said to revenue it's going to do and wants to develop. And I'll come more on to the company requirements shortly. One thing to watch out for from the company's perspective is the timing of when they receive your cash and then issue the shares. It all needs to happen effectively at the same time, but in practice, you will be paying for your shares maybe now, and then eventually they'll get round to issuing the shares in a month or two's time. So they need to effectively hold that in a separate account purely for the investment, so it can come straight back to you if the share issue doesn't carry on and actually take place. So there are some careful things that need to be administered there. And other things to watch out for is a change in the way the company does its business. And again, I will come on to that shortly. The biggest thing to do is for them and you to talk to your tax advisors before making an investment, A, to check that it's okay, and B, to refresh every year to make sure that those various conditions are being met. So qualifying companies for this applies for all three schemes, SEIS, EIS, and for VCTs. Because the government have given away quite a lot of tax relief here, they're going to put red tape in the way and various conditions, etc. So you don't get anything for nothing in this day and age. So those rules are there and they do need to be adhered to. So the first one is, as I mentioned a couple of times, has to be an unquoted company. AIM listing is treated as unquoted for these purposes. There must be trading companies, i.e. not investment businesses. Age requirements, so for SEIS, needs to be less than 2 or with the new rules 3 years. For EIS, there needs to have been either an SEIS or an EIS issue of shares in the first 7 years. If there hasn't been, once you've gone beyond that point, then you won't get any EIS qualification. If you've had one and they're coming back for a second tranche a few years down the road, that's fine. But you do need to have done something in the first 7 years. As a gross assets requirement, generally I would avoid having any subsidiary companies or certain other types of arrangement, which I'll come on to in a minute. There's a number of employees requirement, and needless to say, there are certain excluded trades for various reasons, which again, I will come on to. So, companies qualification, there's a table here of various things which need to be adhered to and the various limits that apply. So in the first column there, I've got 5th of April 23 for SEIS companies. So that's how it exists technically at the moment. Once the finance bill becomes law, then that will effectively backdate to 5th of April this year, 23, and change the investing amounts as well as various other limits that are there. And you can see on the table. Gross assets requirement, the biggest thing to watch out for with gross assets is before liabilities, etc., are taken off. So it's just the gross asset figure needs to be within the limits that are shown there. You've got maximum number of full-time equivalent employees. So you could have, for example, for an SEIS company, you could have 50 employees, but they all only work 25% of their time. So on that basis, you would have in effect 12 and a half full-time equivalent employees. So you'd be okay with that one, but you do need to watch that one carefully. Maximum age, as I said, 3 years for SEIS is what's coming up, and for EIS, 7 years. It can be more than 7 years, but you need to have had that investment in the first 7 years, and various other requirements that are shown on that table. So, as I said, SEIS companies must be less than 2/3 years. This is measured from when the company generally commences trading. Now, it's easy if the company was incorporated and you're sorting out the investment less than 2 years after that. There's then no question about when the company started to trade. But if you are going to have to argue on the trading point, then it's when the company effectively becomes open for business. So not necessarily when you made your first sale or first cost, but when you're open to do business, should someone walk through the front door and say, yes, I want some of your product, please. That can be a difficult date to pin down unless you have a grand opening or something like that. But normally a startup company will not have a grand opening. So it's difficult sometimes to do that. So the safety net is 2 years from date of incorporation. For EIS and VCT companies, as I said, less than 7 years old, or at least having your first investment in that 7-year period. But for those companies, it's measured from when the first commercial sale is actually physically made. So you could be open for business for months and get no sales, and then the first sale comes in, it'll be measured from that date. Exceptions do exist for follow-on funding and entering new product or geographic market, which I will come on to a little bit later on. Knowledge intensive companies has a different rate. It's 10 years old from the date the original shares are issued, and they also have higher investment rates, etc. And I'll come on to knowledge intensive companies in more detail in a little while. So the age requirements for SEIS companies, the other requirements are gross assets less than 350,000. That's now what it will be in the Finance Act when it happens. That's at the date that shares are actually issued, and note it's gross assets and no deductions for liabilities, etc. One thing to watch out for with young startup companies is the value of intellectual property. So initially at day one, the intellectual property won't have very much value. But if you get towards the end of that 2 or 3 year period, then there may have been a lot of development of product or whatever it is you want to sell that's happened. And that could put a lot of value, which is hidden off the balance sheet and won't necessarily be seen. So do watch out for that, because that might tip you over then the gross asset value of the company. EIS and VCT companies have a much bigger number, gross assets less than 15 million before the shares are issued, and then 16 million immediately thereafter. Again, no deductions for liabilities because this is gross assets. If you have got a group, then all the assets of each of the group companies are added together, and then you remove any intra-group investment that might be their debts, etc. That is slightly different to the way the consolidated accounts, if that's what you have in a group situation for your group. It's slightly different to the consolidated balance sheet. Your consolidated balance sheet might have a different figure for gross assets, so do watch out for that. So I mentioned earlier excluded activities. So if your company is doing any one of these types of activity, then generally it will be excluded from having EIS or SEIS or VCT release available to it. The reason that these types of companies don't get the relief is because the revenues view is that they're not risky enough. And I'll come on to risk in a moment. But dealing in land, futures, financial products, accountancy, unfortunately, banking, insurance, etc., property development, gas, electricity, heat and power generation, or providing services connected to one of the above will not qualify for those reliefs, unless it is only a small part of what you actually do. License fees, so royalties, etc., was on or is on the excluded list, but that doesn't apply where you have actually generated in your company that intellectual property which you're then letting out and then receiving royalties or license fees for. So that's how you're doing it, then that's likely to be okay. But if you're just receiving royalties or something from something else, then that's not going to work. As I mentioned earlier, if those excluded activities are just a small part, and you've got something much bigger doing, a qualifying trade or business, then that's okay. Here, it's a 20% tolerance that they will allow. So providing those disqualifying activities are less than 20%, then you'll be okay with that. However, how do you measure the 20%? Well, there are various things and various ways that you can measure it. You look at turnover, profit, expenditure on certain areas, assets employed, etc. A whole list of them that the revenue could apply. Now, the rules actually say that it's the most appropriate measure you work to. Now, the revenue don't quite look at it that way. They'll pick any one, and if any one of those is above 20%, they'll disqualify the relief for you. Unfortunately, that's the way HMRC tend to work. They will look for the way that they can disqualify you from relief, and if they find that, that's what they will do. So do just be aware of that. So, 3-year qualification period for the income tax reliefs. As I said earlier, for all of them, the company has to continually qualify for the release, not just at day one and not just at year 3, but all the way in between. So it's got to meet all those requirements, carry on a qualifying trade, and meet the independence and qualifying subsidiaries rules. And the following rules only apply, though, at the actual date of issue of the shares. So number of employees and the gross asset tests only apply at the date the shares are issued. Clearly, if you're a high-risk investment company, you want to grow quickly, then it will be unfair to give the tax reliefs at day one and require you to meet those 2 conditions continuously for 3 years, when actually you grow exponentially and you're doing fantastically well. Then you've got to be allowed to expand and not disqualify those reliefs because of that. So those 2 conditions only apply at the date the shares are actually issued. As I mentioned earlier, qualifying companies can't trade in partnership, and joint ventures also are to be avoided wherever possible. Particularly watch out for partnership agreements where it could be a partnership agreement, or it could just be an agreement for you to supply services, for example. And then the supplying services could disqualify you. So if at all possible, ignore or steer well clear of joint ventures and partnerships. As I mentioned earlier, high risk companies, there has to be a risk to capital. There has to be a real risk that the investors who are going to get these tax reliefs are actually going to potentially lose their money. And you need to be able to demonstrate that to HMRC that there is a genuine commercial risk here. That's less of an issue for SEIS startup companies less than 2-3 years old, because it could easily go pear-shaped once you've had the investment, it's spent, and you don't quite get to the point that you need to take something to market. But with a company that's a bit older, 5, 6, and up to 7 years old, where you're looking for EIS investment, then that's been going for a little while, and there may be less of an obvious risk to capital if you've got a steady business there and someone's just coming in to put some more money in and help you expand. There are ways that it can be presented or information imparted to HMRC which will help that particular argument, but you do need to speak to your tax advisor on that. As I said there, it's not generally an obstacle for early stage companies though. Okay, next question I think is to do with knowledge intensive companies. So yes, knowledge intensive companies. So I've mentioned earlier what is I'd mentioned earlier knowledge intensive company. So what is a knowledge intensive company? And perhaps why does it therefore get the additional limits, higher, more generous limits that are given to it? So a knowledge intensive company is generally one that will spend one of two things. Either 15% of costs are spent on research and development in one of the last 3 years, or 10% of its costs are spent in R&D in each of the last 3 years, and various other conditions are met. First of all, it's engaged in work to create intellectual property, and it's reasonable to assume that within 10 years, most of the company's income is going to be as a result of generating that IP. And at least 20% of the workforce are skilled employees. And here, skilled employees are ones with a master's degree or higher, or are directly involved in R&D. There are specific rules of companies that are less than 3 years old as well. So what do you do when you actually want to get EIS or SEIS or VCT relief? Okay, so the company generally will have spoken to their advisors, and they'll say, okay, we need funding to either make this widget, work it out, do some research, etc., and then take the matter to market. How do I go about giving some assurance to the investors that they're going to get the tax release that are out there for this type of investment? So you can go for an advance assurance to HMRC, which I think most firms, certainly ours, will strongly recommend for two reasons. One, you give certain bits of information to HMRC, and then they will say, yes, we think you meet the conditions, etc. So if you go ahead and do this, then it's very likely that you will get the release available. Secondly, if you don't do the advance assurance, you're going to have to provide all of that information later on when you actually make the application to HMRC. So quite often, certainly sophisticated investors and business angels will look to see that you have got an advance assurance from HMRC that you meet the various conditions, providing, of course, the information you've given to HMRC is accurate and correct and not misleading. So how do we go about that? So an advance assurance is an online application. It's online form filling. Not as helpful as you might want. So whilst they do give some guidance as to the information they're going to want from you, as you turn over each page online, so the additional information comes up that they're going to ask you for. Unfortunately, you can't find the whole complete form, so you can go away and get all the information, have it in front of you before you're doing it. But generally, you can save what you've got and then come back to it later on. So it can be a painful process to go through. But there are some things that you will definitely need, which I've listed there. So you'll need a business plan. You'll need financial forecast, generally at least 2 years, 2 to 5 years is good. Budget, setting out what you will spend the money on that you get from these people if they invest in your company. You'll need to provide company articles, etc., and any shareholders agreements, either that are in place at the moment or that you're intending to put in place. And the tricky one at the bottom of the list there is a list of your intended investors. Now, you might not know who those investors are. You might have a list of 1, 2, or 3, but you might be looking for an investment of a couple of £1 million or something like that. But these investors have said, yeah, I'll put in 10, 20, 30,000 each. So nowhere near the level of investment that you've got. But if you have got some investors who are intending to invest, providing they'll get the tax release, etc., then put that list down. You can always say, there will be others to follow afterwards. Part of the reason I think the revenue want to see that is that it then appears much more serious that you're not just trying it on, because in the past a lot of companies started up, threw in an advance assurance. If they didn't get it, fine, shut up shop and walk away. Whereas what they are looking for here is serious business people who are really trying to get their business going and just need the investment to do that. Okay, so you've gone through the advance assurance, you got that back from the revenue, and you've issued the shares. The revenue will have sent a formal letter back to you, in effect, saying, yes, we think you meet the conditions. Once you've issued the shares, then you need to complete various forms. So it's an SEIS1 or an EIS1, which is a compliance statement, basically saying, that's what I said before. Yes, I continue to meet those requirements, and yes, I've issued the shares. It's not complicated. It's just a laborious process to go through to get there. And of course, I have to say, BDO have a team of experienced tax professionals who are quite willing to help with everything from the business plan all the way up to dealing with the issue of shares, etc. So EIS and VCT schemes are state aid. So when we were in Europe, there were issues with the level of funding that could be provided. We're now out of Europe, so the limits on state aid are now no longer technically there. I think that's part of why they've changed some of the rules recently, and there may be further changes in the pipeline. We'll have to see. But certainly Brexit has taken some of the shackles off of the sorts of reliefs that are there and available at the moment. Any other questions that anyone might have this afternoon for me? I'll do my best to answer them. And if there aren't any questions, then there's a little disclaimer there so that you can ignore everything that I've said this afternoon. But no, seriously, if you do need some help with anything to do with SEIS, EIS or VCTs, be it that you're the investor or a company looking to gain investment, then by all means contact me through any of the hosts here today, and I'm sure they'll pass it on to me so that I can help with that. So without further ado, either Susie, Emily or John, if there are any questions that people have fired into us, then I'll do my best to answer them.
Well, certainly, Colin, nice and in depth. And yes, we've got some interesting questions that have come along. Oh dear. So this might take a little bit longer than the 5 minutes we've allocated for questions. So do be patient. So, okay, what would be the impact on the SEIS investment if within the 12 months after the 200,000 SEI investment, you need to raise further investment? Would that fall under EIS? Would it nullify the SEIS qualification to change it to EIS, or not affect it at all?
Right, you would go for the EIS investment second time round, and you can then do multiple rounds of EIS investment up to the limits that applies. It doesn't change the tax release for SEIS, doesn't nullify it at all. They still continue to qualify, providing the conditions are met, which if you're going for EIS, then there will be the same or similar conditions as they were for SEIS. So yeah, that's the way they've designed it, so that you can start up small. If you grow really quickly within the first couple of years and need more money to take your particular product to market, then that's fine. Just go down the EIS route, and you can have as many tranches of EIS investment as needed as things progress.
Great. So for a KIC, knowledge intensive, does the 20% skilled workforce have to be directly employed, or can you include contractors in that list?
You would not include contractors in that list because they are what they're, and that can affect you actually meeting the condition. So you do need to be careful with that, because you might have some general people within your company and therefore the 20% condition is not met, and you cannot include subcontractors. So you need to make sure that you employ sufficient so that you meet that condition. It doesn't stop you from having subcontractors. You can still have, other professionals in elsewhere feeding into your organization, but just make sure that you within your organization have employed the relevant number of people to meet that condition.
So moving on to advanced assurance.
Yeah.
The list of investors that you have to provide, do you have to provide a detailed list, or is there an acceptable way of not providing a complete list of named individuals?
There are, in fact, most of the advanced assurance applications that I have made have not ever had a complete list of investors. Be it because other people have then come along or heard about it and then said, oh, I'll have some of the action, please. Or in most cases, you simply don't know. You find 2 or 3 who are willing to invest, subject to you getting the tax release, etc. You put them down, and then others as we can find, because you'll tend, and from a practical perspective, you don't want to waste your time and energy going out finding investors and going, will you put your name down? Yes, I'll do this, and subject to getting tax release, etc. And then go to revenue and then find you can't have the tax release, because you're then going back saying, sorry guys, can't do it, etc. And the reality is that businessmen in startup companies are running around like headless chickens anyway, and they just don't have the time to spend going out there trying to encourage people to invest in their companies when there's nothing on paper to say, yes, I will get the tax release. Most people tend not to say, yes, I'll put my money where my mouth is. When you have the tax release, I'll do that. So yeah, find a couple of friendly people to put their names to it. No conditions, if you don't get a release, etc., or I can pull out if I decide not to, etc. But that's the way to do it. Put a couple down there, or 3 or 4. If you got more, fantastic, and then find the rest once you have those released. And it is more attractive when you've got that piece of paper from revenue saying, yes, we think you're okay for this.
So we now have a question about joint venture companies. Now, I know in your presentation you said avoid joint venture companies, but we do get to see this quite a lot these days. And this is a simple one to start with, but it gets really complicated when we get into the details. So I will keep it brief because we don't have an awful lot of time. So Company B is a startup new venture seeking funding. Company A is one of the promoters of B and owns up to 50% of the shares in B. What are the rules and regulations on Company A directors being on the board of Company B and there being non-connected board members?
If Company B is an entirely is heading into or trying to start up a brand new product or going to a brand new geographical area, then you might have a possibility of getting EIS or SEIS. But in 90% of cases, I expect the revenue to turn around and say, no, you're not having it. And the reason is simply this. If Company A itself, instead of having a new Company B, was to do that same activity itself, expand into a new market, etc., or new geographical area, could it qualify for SEIS or SEIS on a share issue? if you can answer that question with a yes, because you're issuing shares to new people who are investing directly and funneling it into that new product or new geographical area, then you've got a chance. But if that's not the case, because you've got existing directors who are investing in company B, then they will say, no, your connection is more than what we're going to allow. It's all you're doing is expanding, and this is the difficulty with going into a new geographical area or a new product, is the revenue tend to say, no, you're just expanding your existing business. And the whole reason for setting up company B is to try and enable you to get the SEIS and EIS release, which was the tax avoidance point that I mentioned close to the beginning, and therefore will tend to say no. If, however, company B was having all new investors come in, but the directors or key managers from company A are helping company B to get off the ground, do its business, etc., but are not themselves seeking those EIS and SEIS tax release, providing it is not in the same trade as company A, then you've again got a possibility of doing that, because all you're doing is effectively hiring skilled people to come along and help the startup. But it's fraught with danger, I would say, and a difficult one. And the revenue are now, as of late, being even more difficult than they were 2 or 3 years ago. So they will look, as I mentioned with certain other things, they will look for ways not to give you the relief that's out there. So don't give them an excuse that allows them to do that. In this situation, I would have company B totally separate. By all means, helped out by company A, but it has to be effectively at arm's length, and keep the individuals in company A away from company B if at all possible.
And I take it that if employees of company A who are now working in company B but got their shareholding for in payment in lieu of helping to set up company B, that would disqualify them from EIS full stop, wouldn't it?
Yeah, absolutely, yes.
And I think from a shareholder's point of view, and I'm speaking as a shareholder, an investor, I would not want to invest in company B. I would want to invest in company A, because that's where the knowledge and the know-how actually is. And why would you invest into a company that is almost 50% or over 50% owned by another business anyway?
Well,
you have no rights.
If it's over 50% held by company A, then company B effectively becomes a subsidiary of company A. So you would not get EIS relief for investing in shares in company B anyway. If company A held less than 50%, so it wasn't technically a subsidiary, any money that company A lends into it would need to be by way of loan rather than share capital or anything along those lines, which is, it can work, but you need to have professional advice and help to make that work for you, because otherwise it's just too easy for the revenue to catch you out. Or equally, you might qualify at day one, but when the revenue look at it 4 years down the track and look back and trawl through what you've done at each and every stage, there can be a number of bear traps that suddenly, and you've only got to trip over it, for 5 minutes, and then all of the tax release disappear, and you have a lot of very upset investors and shareholders in the company then, and it doesn't go down well.
And I think your slide sums it all: avoid joint ventures.
Yes, yeah,
Yeah,
absolutely.
Definitely.
Yeah.
Colin, thank you so much. That I'm not going to have any more questions, and so I'm going to leave it for Susie to wrap up.
That was fantastic. Thank you, Colin. And thank you for all the very in-depth questions by Rob, especially, and Aparajit. Anything else you want to add, Colin? Oh, also to Tracy, PDF slides will be shared. Is that okay, Colin?
Yes, that's fine.
If
Yeah.
you request it, yeah. So hopefully, Tracy, if you do request it, that will be shared with you from our inbox. Thank you so much for today. I'm going to stop recording now. Take care, everybody.
Perfect. Thank you for listening, everyone. Bye-bye now.
Take care. Bye.